Stocks mixed today as markets search for direction to begin the new year, but history tells us we're in for another double-digit return for the S&P 500. For more, let's bring in Ryan Detrick, Carson Group Chief Market Strategist. Ryan, always great to see you. So listen, Ryan, it was a great 2024. You were here with us for a lot of it, my friend. 2025, Ryan, what should we expect after you did have these back-to-back 20% gains?
Well, first off, thanks for having me. I'm in Cincinnati, totally snowed in, so hopefully most of the country is starting to get out of that. And Josh, glad to be back, and Julie, hi, and glad to be back. So let's get into it. We've been pretty optimistic. As you said, I've come on a lot, but we still think this year's going to be pretty good. Now, let's just start high level here. After a 20% gain in the S&P 500, that following year is actually up more than 10% on average, higher 82% of the time. That's better than your at any time return of about 9% and up like 72% of the time. But we're up back to back. We're up 20% 2 years in a row. So listen, that's a lot. We get it. But it's only happened 4 times since 1950. So small sample size, sure. I'd still rather know than not know. Josh, when you have a back-to-back, that next year, only 1 time in the 50s, 3 times in the 90s. That next year's been higher every time, 4 out of 4, up 20% on average. We don't think 20%. We think between 12 and 15 makes a lot of sense, but we think this is still a bull market. We can get in all the weeds of it, but just because we're up a lot, that doesn't mean this bull market has to end. In fact, we don't think it's going to.
Obviously, and it's good to see you, we're not quite snowed in, but it is freezing here in New York City. The sentiment has definitely shifted over the past several weeks, right? Part of that has to do with what we have seen happen in the 10-year yield. So how much of that is going to be an obstacle to your thesis for this year, or is it not?
Well, that's a great question. It's what I'm thinking of every day. Because again, a year ago, when we were bullish, people gave us some weird looks. 2 years ago, we said no recession, bull market. People hated that call. Now I look around, it feels like a lot of people are agreeing with us that things are overall pretty good. But I tell you what, real short term, what are we seeing, right? And you just had some great discussion before I came on. I think Jay Woods pointed out, 50% of stocks above their 200-day. Last time we saw something like that was a 10% correction. Obviously, a lot of stocks have seen some weakness really since, I guess we'll say December. But you look at some of those sentiment polls, right? The NAAIM exposure, RIAs, huge 4-week drop. The AAII, individual investor, like the least bulls we've seen since I believe it was April of last year, a fairly significant low. Put to call ratios, options markets getting kind of freaked out. So Julie, to answer your question, the near-term things we're seeing are flashing kind of what we've seen near lows before. And I'm not saying we're right at a low here, but there's a good amount of fear, and rightfully so. We had a great run, and now all of a sudden, stocks can go down. We were down in December, pretty rare, yes. I did not think we'd be lower in December, but we were. So we have to respect that. But overall, we're in the ballpark, I think, where you tend to get some type of a manageable intermediate term low.
Ryan, to Julie's question on the 10-year, I'm just curious, are there levels you're watching that you think, okay, that becomes a problem for the equity market? There was a piece in Bloomberg, Ryan, it was interested about how there's this growing course of fund managers who say, listen, that Treasury market repricing might not be over. It might have further to go. How options are indicating a spike in the 10-year to 5. Would that be a problem for the stock market?
Yeah, I think so, Josh. I mean, listen, I think 475 is kind of that big level where we were, I guess I could say earlier this year, but it would be last year at this point. We're not that far away from that. Of course, 5 is that major psychological level. I mean, let's be clear, though, why have yields been going higher? And then because the economy is pretty strong. I mean, overall, most of the economic data has been pretty solid. And we're going to get more labor market data soon here. But you think about where, everyone's thinking alike, somebody isn't thinking. That's a famous saying. I use it a lot, General Patton. And everybody feels like is bullish the U.S. dollar and looking for higher rates. And we get why, right? We get why. But just know a lot of this stuff is priced in. Our base case here, over at Carson is we probably see 2, 3, maybe even 4 cuts, not necessarily right away. We still think inflation is going to improve. We had every guest come on with you guys, and I have too, talking about shelter, look at real-time rent data. Inflation's going to continue to improve. So to us, the economy's pretty solid. Inflation comes back. There's probably going to be more cuts this year than people are pricing in right now, and that maybe not going to happen right away. Might not take till the second quarter, I'll be honest. But some point during this year, we're going to have a lower move in the dollar, lower move in yields, and that's probably going to be a pretty, honestly, pretty bullish event if and when that takes place.